It's interesting, right? When you take a look at what this divergence that we've been talking about, do you think we've reached sort of peak optimism when it comes to the U.S. and then still talking about peak pessimism when it comes to China? And what is the way to position around that?
Sure. Good morning. Good to be here. When it comes to the U.S., I think this is going to be one of these long-term structural things. You're going to have one good day, one bad day in terms of the geopolitical relationship. And it's hard to call on any given day where we are. But I think gradually the market will just get used to that as the new normal. But when it comes to China, really it's coming down to the economy. And as you mentioned earlier, the Chinese recovery has been underwhelming so far. And I think the core of the problem is the lack of confidence by the consumers and the small and medium enterprises. And at this point, little policies probably aren't enough. You need something bigger, something to sort of shock people out of the slumber.
And John, while we wait for that, David here, good morning from Hong Kong, by the way. What's your exposure like at this point to this market, and what are the biggest adjustments you've made recently?
Sure. Hey, David. As we know, the risk assets for Chinese equity and the macro are not necessarily always linked on the near term. So the interesting thing about this is the market pessimism around Chinese equity is probably at a level of extreme we haven't seen for a while. And so at this level of pessimism, some of the risk assets start to look quite interesting for us. And I think when it comes to positioning, we as bottom-up fundamental investors, we like to find stocks and companies that have a foot in domestic market, but a foot in something else that in case you don't get this type of large stimulus, I can still do well, right? Companies in the industrial cyclical space, for example, the bus makers, the diesel engine truck makers, they are actually enjoying quite a good year-to-date, both performance and earnings trajectory, but mostly from their exposure to emerging market exports.
Okay, so maybe those are things that are maybe immune, as you mentioned, to maybe some sort of slowdown. You have two funds that we're showing here right now, low vol and A shares. Just walk us through why you think, what is considered to be low vol right now within the China equity market, and how you determine that in some ways.
Sure, and the answer is fairly simple for low vol. Is looking for companies that have a lower residual volatility versus the market. And the idea for low vol is really to protect on the downside. But for us, we're not asset allocators, we're bottom-up stock pickers. But nonetheless, if you've gone to my head, we think A-shares are more interesting. A-share is the market that's least exposed to external capital flows, geopolitical sentiment, and most exposed to domestic recovery story. And even though the recovery has been underwhelming so far, but there are parts of the economy that are still doing pretty well, right? Consumer spaces, things like leisure and travel, even though total spending maybe is not as high as people were hoping, but some of the travel numbers are pretty good. It does show that Chinese consumers are trying to wake up. I think what we need, as we talked about a little bit before, is just that little bit of policy push to get things going.